I made a list of 5 common mistakes retail investors do to show you how, by avoiding them, anyone can really maximize profits even if they are still at the beginner level. As retail investors, all have something in common. Our first decisions were probably our worst.
You should have gone for the head.
And we put our money, our time and our effort into our investments, and there's these 2 big problems holding our profits back time and time again. First, the common mistakes that we all make that wreck gains. Unfortunately, these are incredibly hard to recognize when you're doing them. Secondly, our strategy might indeed have something good, but we just don't know how to take it up to that next level to achieve the best outcome. By pointing out these common mistakes and then showing you how to avoid them, by the end of this video you'll start to spot them in your own strategy, but you'll also have the knowledge to do something about them too.
A great success!
Okay, I'm gonna start with one which at start seems very obvious, but it is a huge killer for portfolios, and just getting good at noticing it is really gonna improve your profits. Now take a look at your portfolio, every investment one by one, and read the names of the stocks that you picked. Okay, now pretend you are with a friend and try to explain what every company you own does, how they are making profit, what is the thing that they have to do in order to increase their revenue, what is their business model. Can you do it? So there we are. Did you spot it? The problem is ignorance. In the retail investors community, 90% do not have full knowledge for more than 50% of their portfolio. That is why I always say, if you don't get it, don't touch it. Too often investors gravitate towards the latest hot industry. They may know very little or even nothing about technology or biotech or the specific business the underlying company is engaged within, yet they think it will be the next profitable investment. But when you understand the business, you have a naturally built-in advantage over most other investors. For example, if you run a restaurant, you may be in tune with the back-end business involved with restaurant franchising. By extension, you will know if the industry is booming, getting slower, or cooling down well before the vast majority of investors, making it easier to make strategic investment decisions. When you invest outside your realm of understanding, you may not know the subtleties and the complexity of the business in question. This is not to say that you need to be a gold miner to invest in gold mining companies or a medical doctor to invest in healthcare, but that certainly wouldn't hurt. The legendary investor Warren Buffett is well known for his aversion to investing in companies he doesn't understand, most notably tech stocks. Although this personal policy meant Buffett missed out on Microsoft when it was just starting out, it also meant that he avoided countless companies that went bankrupt. So now I'm gonna quickly make a sample portfolio with 5 stocks from different sectors. I'm gonna have Apple for technology, Twitter for social media, Fluor for construction, Devon for energy, and Coca-Cola. I'll set an initial amount of $10,000, split that amount evenly 20% on each stock, and say that we got started in 2013, so we have plenty of time to see some development in our investment. If we analyze this portfolio, we see that at the end of July 2021, we would have around $16,000 with a 6% annual return. Okay, that's something, but it's not that great, and if you look closely, a big chunk of those profits came just from this last year. Actually, you see that for a period of time there was a 51% drawback, which maybe you can handle, but for some investors it's like, come on, I can't stand it, I'm gonna sell. Digging a little deeper to see how each one of our picks did, we see that Apple did really well, giving $5,000. On the contrary, Fluor and Devon, well, not so good. And that's normal, since we can't know everything, right? We maybe understand how Apple works and how crazy people are to buy the new iPhone, which leads to more profits, but we have no idea why a construction company tumbled in a year. Now, am I suggesting you put all your money into Apple? Of course not. After all, diversification is the basic element of every portfolio. Let's try something else and put our whole initial amount in VTI, which is an ETF that tracks the performance of all US stocks. This way I don't have to rely on a company that I don't know anything about, having a safety net when things go bad. The annual return more than doubled at 14%, and we would have $27,000. And there you have it, with the same amount invested, 80% more money. Now you're gonna ask, what about if we keep invested every month in this portfolio? And that's a really good question. Well done. Let's see what's happening if we put, let's say, $200 every month. The annual returns got a bit better, but we still miss $16,000 from our net worth. Now that brings us on to an averaging down. In a nutshell, averaging down means adding to a losing stock position in order to reduce your average share price. For example, let's say that you buy 100 shares of a certain stock for $50 per share for an initial investment of $5,000. If the share price falls to $40 over the next month, you could buy another 100 shares at that new price. Now you own 200 shares and have invested $9,000 for a lower average per share cost of $45. Going a step further, we'll say that the entire market plunges and your stock falls to just $30 per share. If you then buy another 200 shares for $6,000, you'll own 400 shares altogether at a total cost of $15,000, an average price per share of $37.50. To sum it up, the main advantage to averaging down is that you'll have lower cost basis per share. In our example, if the stock rebounds to $40, you'll make money. But if you hadn't averaged down and had just held your original 100 share investment, a rebound to $40 would still leave you down $10 a share. The main disadvantage of averaging down is increased risk. Obviously, investing $15,000, as in our example, means that your portfolio's performance depends far more on this one stock than if you had just invested $5,000. The big question here is, when is it right to do it? There are two main reasons why you should and two reasons why you should not. Of course, the goal is to not even have the option of averaging down on your positions. In a perfect world, you'd buy a stock and it would go straight up. But when a stock moves in the wrong direction, averaging down can be a good option in the right circumstances. The general concept you need to know is that averaging down can be a smart idea if and only if your original reason for buying the stock still applies. That is, there is no permanent change to your long-term investment thesis. For example, one good reason to consider averaging down is if a company misses quarterly estimates and the stock goes down. A good real-world example is Apple's plans in mid-2016 due to a revenue decline and the first ever annual drop in iPhone sales. The stock fell from about $120 in late 2015 to about $95 after the company's second quarter earnings report in April 2016. The key point is that short-term headwinds were dragging on the stock, not any fundamental change in the business. Overall market weakness could be another good reason. If the entire market takes a dive and pushes your stock prices down with it, it could be a good idea to buy even more of your favorite long-term investments at a discount. As I mentioned earlier, one big downside of averaging down is increased risk. Think about it. By averaging down, you're increasing the size of your investment. So if that investment continues to fall even further, your losses can become even greater than if you had left your investment alone. With that in mind, there are two main situations when I would avoid averaging down on an investment. The first is when my investment in that particular stock is already a large one. My own rule of thumb is that I don't like more than 10% of my stock portfolio in any company under any circumstances. The second scenario is if the price fell because something fundamentally changed with the company. In my Apple example, weak iPhone sales in one quarter were not a thesis-altering development. On the other hand, if a competitor were to start taking market share from Apple and created margin-eroding pricing pressure, it would be a different story. Okay, next we have another issue that we have to address, and this one is rebalancing oversight. Rebalancing is the process of returning your portfolio to its target asset allocation as outlined in your investment plan. Within a diversified and risk-managed portfolio, some investments will outperform over the course of a year, while others will underperform. At times, it may force you to sell the asset class that is performing well and buy more of your worst performing asset class. Not doing so may result in taking on more risk than you had intended. For example, if you don't rebalance after large market gains, you may be overbalanced in some stocks which may not be the right fit for your circumstances. Owning 10 stocks but having 90% of your money concentrated in just one stock means you are not diversified. While your portfolio might start with a healthy balance, this has a tendency to shift over time. Winners get bigger and losers get smaller, which will throw your balance out of whack. For example, imagine you invest equally in 10 stocks and one of them gains dramatically in the first month while the others decline. If 25% of your money is now concentrated in that one winning stock, you'll want to consider rebalancing. Rebalancing involves adding to or selling off your positions so that they become more evenly balanced. In the example above, you might consider trimming the winning position back to 10% of your portfolio. If your portfolio balance shifts too much, your returns will be overly influenced by the 1 to 2 stocks that now hold most of your money. As part of a disciplined investment strategy, consider periodically rebalancing to bring your portfolio back into line with your target allocations and risk tolerance. Maybe you want to rebalance your portfolios once or twice a year, or set a limit on how far an asset class can diverge from its target percentage. Whatever your approach, don't forget that not doing so is one of the costliest mistakes an investor can make. Always keep an eye on your portfolio balance because it's a key part of steady long-term returns. Number 4 is what I call the know thyself deprivation. Rookie investors don't account for risk tolerance when determining how to balance investments across multiple asset types. Your risk tolerance refers to how much risk you can afford and are willing to take with your investments. If not calculated right, you will have a reason that keeps you awake at night, and if reality overcomes that risk level, your inner self tends to lean into fear and panic selling. Risk tolerance is the ability to withstand losses when your investments perform poorly. If you buy stocks, for instance, how much of a drop in the market can you stomach? If your tolerance is low, you'll invest conservatively. For instance, a greater portion of your portfolio might be in low-risk bonds and a smaller portion in higher-risk stocks. So we need to find a way to assess and clearly understand how much risk we can take in every time we invest. And to do that, we need this: the 5 factors that determine our own tolerance capacity. The purpose of financial planning isn't to accumulate the biggest pile of money possible, it's to decide what you want out of life, calculate how much money you need to reach those goals, and then choose an investment strategy that will deliver the appropriate returns. Generally, you can take more risk if you have a lot of time to ride out the bumps. If you're going to need money in 5 or 10 years, that's much different than if you have 15 years or more. A 30-year-old who's saving to retire at 65 has plenty of time to wait those out, but if you're saving to buy a house in a few years, investing that savings in stocks is too risky because there likely won't be enough time to recoup losses if the stock market drops. If you are in your 80s, that tolerance can't be as high as it would be for someone in their 30s. At 30, you've got time not only to ride out volatility, but to make more money working. Someone starting retirement with a $5 million portfolio may be able to take more risk than someone with $500,000. The person with a larger portfolio has more cushion if values drop. Some people are naturally more comfortable with taking risk than others. If market volatility is too stressful, that's a signal that you need to understand better what to expect or to be in less risky investments. Lastly, I left something that does not directly correlate with losing money, but can really save you time and keep your stress levels low. I believe in active investing. That means rebalancing your portfolio when needed, reinvesting dividends, and always making sure you're holding the best possible stocks for your investment strategy. That involves frequently checking your investments, monitoring the market, and researching new stocks. However, be careful not to look at your portfolio too much. It's a common investor mistake to check your stocks too frequently and fixate on the daily or hourly changes in value. Watching your portfolio's every move up and down tends to activate the emotional pathways of the brain, fueling excitement around gains and disappointment around losses. And once our emotions around money are excited, it's much harder to make rational decisions that will help us over the long term. Surely, checking up on how your investments are doing is a good thing, but the danger is that the more investors are exposed to news around their investments, the more they may see them going down. Whereas share markets have historically generated positive returns more than 60% of the time on a monthly basis and more than 70% of the time on a calendar year basis, on a day-to-day basis, it's close to 50-50 as to whether the share market will be up or down. Being exposed to this very short-term noise and the chatter around it can cause investors to freeze up, or worse, can feed on your natural aversion to any reduction in the value of your investments and thus encourage a greater exposure to lower returning but safer investments. The trick is to turn down the noise and have patience. Evidence shows that patient people make better investors because they can look beyond short-term noise and are less inclined to jump from investment to investment after they have already had their run. So now that you know what to do and what not to do, check out this video so you can get more stock investing ideas. See you next week. Bye bye.